Investing in rental properties has long been known as an excellent way to generate cash flow and supplement your income. But with housing prices skyrocketing, it's hard to know what amount of cash flow is a good deal right now, and it's even harder to know how to adjust your strategy to this insanely competitive market. What's up, everyone? I am Dave Meyer, real estate investor and VP of Data and Analytics at BiggerPockets, and today I am going to talk about a very popular cash flow metric known as the 1% rule. And I know this might come as a shock from a guy who works at BiggerPockets, but I just don't think the 1% rule applies anymore. It's time to kill or at least adjust the 1% rule, in my opinion. But don't worry, even without the 1% rule, there is good cash flow to be found, and I'm going to help you find it. And I'm also going to help you understand some very simple math that explains how you can generate great returns in real estate simply by breaking even from a cash flow perspective. Before we jump into all of this, please do me a favor and subscribe to the BiggerPockets YouTube channel and give this video a like to make sure you get notified of all our new videos. Now, for those of you who have been following BiggerPockets over the years, me saying the 1% rule is dead is probably pretty shocking. We've been preaching the 1% rule forever. The 1% rule is a misnomer. It's not really a rule. It's a rough guideline that should be one of many metrics you look at before investing. It's not a be-all, end-all of real estate metrics. So let's just quickly talk about what the 1% rule is, and then I'll break down why I think it needs to change. The 1% rule uses a popular metric known as the rent-to-price ratio, which I'm going to call RTP, and it's basically a proxy for cash flow. All you need are two inputs, rent and price, which make it really easy to calculate. And all you need to do is divide the median rent by the median home price. So you can do that for an entire city or state or neighborhood, or you can do it for an individual deal. Either way, it works the same thing. You divide rent by purchase price. If you had median rent of $1,000 in a city and the median home price was $200,000, RTP would be 0.5%. I actually simulated cash on cash return recently and did this whole big study to see if RTP actually works to predict cash flow, and it does. The correlation is 0.85, which is really strong. If you haven't been to a math class in a while, correlation only goes up to 1, so 0.85 represents a very strong relationship. So my gripe here is not with using RTP as a measurement. I actually think it's an excellent tool to screen markets, neighborhoods, and to do some back of the envelope math on a deal you're considering. Instead, my gripe is with a rule that states that RTP has to be over 1% in order to be a good deal. I actually see this on the forums and hear from people all the time that they say, they want to buy a deal, but they haven't done it yet because they can't find something that meets the 1% rule. Stop doing this. This isn't law. It's not gospel. It's a rule of thumb, and one that honestly used to be more useful than it is today. See, the 1% rule was developed during a very different market. It was right after the financial crisis over 10 years ago. And what happened during the financial crisis was that housing prices declined much faster than rent. And this creates the perfect scenario to create high RTP. You have high denominators and low numerators. In the early 2000s, this trend continued, and eventually home prices started to recover and rent rates just didn't keep up. And this creates lower RTPs across the country. Just take a look at this chart. It shows exactly what I'm talking about. In the financial crisis, rents declined, but only modestly, while home prices took a real dip. But the market has now changed. Housing appreciation is outpacing rent by even more. And I think we all see that in the market and the news every day right now. And yes, a lot of this is due to the pandemic, especially the crazy appreciation of late, but it started before that. Cash flow and RTP are just harder to find than they were previously, and that started before the pandemic. As such, we need to adjust our expectations. What was considered a benchmark in 2011 cannot reasonably be used as a benchmark in 2021 if you want to be an active real estate investor in this market. My second gripe with the 1% rule is that it's a nice round number, but it doesn't actually represent the line where cash flow becomes positive or negative. In fact, my research shows something quite different. I found that the average RTP in the US was actually 0.51%. So even if you found something at 0.77%, you are way above average. I also found that the cash on cash return on average is negative 7%. So if you are cash flowing at all, you're ahead of the game. Philadelphia, as an example, has an RTP of only 0.77, so it does not meet the 1% rule, but has a cash on cash return of 11%. That is an incredible cash on cash return. So clearly you would miss some really good deals if you were only looking at the 1% rule. And then lastly, Avondale, Arizona has an RTP of 0.56%, but has a positive cash on cash return at 1%. So you can actually generate a well above average return with an RTP as low as 0.56. To me, this is basically just saying what I've already said. You can't just rely on the 1% rule, because as we've seen with cities like Philadelphia, you would miss out on excellent cash flows with an RTP of 0.77. So while it doesn't have the same ring to it, I understand, I believe that for the purposes of screening cities or neighborhoods, anything above 0.5% should be considered. And I'm saying that because we're talking about the average deal in a city. If the average has an RTP of 0.5% and a cash on cash return of 1%, then you can absolutely find deals better than that if you are a diligent investor and find an above average deal in your market. However, if you're using RTP to screen a specific deal, I think you can bump up that threshold to about 0.65%, and that's when it becomes worth actually entering assumptions and expenses and figuring out exactly what the cash flow will be. Speaking of cash flow, I will quickly talk about my last point. Cash flow isn't that important. I know this is going to get a lot of reactions, but let me explain. If your goal is to quit your job soon or you're nearing retirement age, then cash flow is super important. So if you're one of those people, just ignore this last point. But if you're like me and your plan is to keep working full time for another 10 to 15 years, you should be investing for total return, not just cash flow. That is, you should be factoring all of the ways you make money in real estate investing when you analyze a deal. That's cash flow, sure, but it's also appreciation, it's amortization, and it's taxes. By just looking at the 1% ruling, cash flow, you are forgetting about 3 other ways that you generate returns in rental property investing. I try to maximize my total return. I love cash flow, sure, but I also want to build equity. Because at the end of the day, if you build equity and build up your total amount of net worth, you can turn it into cash flow later. It's actually pretty simple. Here's a quick example. If you build up $2 million in equity, you could sell your entire portfolio and then buy a property for cash. And just as a reminder, when you're buying a property for cash, the cap rate is equal to cash on cash return. So if I could use $2 million and buy all cash deals at a 5% cap rate, I would be cash flowing $100,000 a year, which sounds excellent to me. If you could buy an even better cap rate, let's say 7%, you would be generating $140,000 a year. So I'm not saying I'm necessarily going to do that or you should do that, but just as an example, if you build equity, you can always turn it into cash flow later. So if you don't need the cash right now, don't get obsessed about cash flow. Think about the bigger picture and think about the long run. If you look at this market and you look at the crazy things that are happening, you'll see that high RTPs and high cash on cash returns are just hard to find. But that doesn't mean real estate investing cannot generate great returns. I encourage you all to think about appreciation, amortization, and tax advantages when you're evaluating deals to see if these deals are going to be good for your long-term strategy and your personal goals. All right, that is my rant about the 1% rule. I can't wait to see what people say about my assertion that cash flow doesn't matter that much. I'm Dave Meyer, and I will see you all next time.